Today, ladies and gentlemen, we're breaking down 3M, science applied to life. If you don't know what 3M is, it is a conglomerate in the U.S. that makes all kinds of weird products, and it has been on the decline lately with a $95 billion market cap because we just shed under $100 billion recently with a 17.5 PE and a 3.5% dividend yield. But I want to break this crash down to you and what is going on, and is this company a buy? So let's jump right into this. Welcome back, passive income investors. I want to break down to you what exactly is going on with this company, because some people I know own this company and it is a wonderful dividend stock, and we're going to break down all the financials, the dividends, and everything else in between. But let's start with why this company is on the decline. Looking at 3M down 8% after a little more than 8% after big miss slash guidance and job cuts. That headline does not sound good, but as we read through, we'll say pre-market after estimated Q1 earnings and revenues cutting 2019 outlook while announcing a 2,000 people job cut to save on 225 to 250 million a year. Q1 was disappointing to start the year, CEO Mike Roman says, painting to slow conditions in key end markets, which impacted both organic growth and margins. Q1 sales fell 5% year over year to 7.86 billion. Industrial sales sank 6.6% to 2.9 billion. Seeing about a massive cut in slashing their guidance, which is pretty scary in a sense, but I'm going to explain to why this shouldn't be so fearful if you are a shareholder and what we're going to learn about this, because 3M has been, the more I look into it, the more of an interesting company it becomes. If you don't understand 3M, let's just take a quick peek at their video here. Let's take a quick listen as well. Let me crank the volume for you.
Did you know you're never more than 10 feet away from 3M Science? It's in our projects, our homes, our hospitals, our job sites, our cars, just about everywhere. From the smallest objects to the biggest objectives. But to us, it's not just about the products we make. We're a science company, working to improve lives everywhere, every day.
This company is basically a conglomerate, again, massive market cap, selling 55,000 plus products in these industries, automotive, commercial, solution, transportation, healthcare, manufacturing, energy, safety. Like it's literally like a piece of America. Well, actually globally, it's a little bit bigger than America, and we'll see that when we get into their books. But if you don't understand 3M well enough, trust me, just hop on to the old Wikipedia here, and you should listen to just this company's initiatives, how they've grown since their inception, which has founded in 1902, 116 years, which is just ridiculously staggering. And the other thing people are having a hard time understanding is their dividends. But when we're taking a quick peek at this, guys, it's kind of weird that a company like this has been increasing dividends for so long and is increasing dividends even though they're losing revenue. And they're being able to do this because they don't pay out a huge amount of their cash flow and profits to shareholders, which I'll explain a little bit more about in a second. And if you weren't excited enough, guys, maybe you want some Safety Walk General Purpose Tape Black. Or I don't know, their products are like earmuffs and the most boring things, but things that we actually need to use in life, and they dominate in many of those industries. So if we hop over into their books here and break down exactly what this company's doing, and might I say, I always like looking at websites, guys. I think a website really explains a company, and unlike Magna, this company does a really good job laying out basically their products for consumers, their investor relation page. There's a lot going on here, but it's clean. It's nice. I don't have any complaints about it, and especially you'll notice this when we look into their science applied to life first quarter business review. So just one of their presentations. I like when they keep things short, simple. We got 25 pages that we can scroll through really, really quick, taking a look at some of the forward-looking statements, which means a lot of this is just guessing and blah, 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 blah. Educated guessing, I'm going to say. A disappointing start to the year. They're so honest about this. You got to admire that. They're not hiding anything, taking aggressive action. Litigation updating 2019 guidance, business group realignment, which is good. So this is what they were saying in that review, guys. As we can see, minus 1.1% organic local currency growth. So because they deal with so many countries, the conversion on currencies really can affect their income as well, which is something we need to pay attention to. Restructuring and other actions, guys. So Their estimated reduction of 2,000 positions globally pre-tax of approximately 150 million, annually pre-tax savings about 225 million from cutting those 2,000 jobs. It's not like we ever want to see a company scale back in size, but when you're adding a company like 3M to your portfolio, you're adding it because it's like a boat, not like a boat, like a tanker, like a huge, massive, just crazy yacht tanker with jets and I don't know, whatever you want to think of it as. It's just something that doesn't move very fast, but it's never really going to go anywhere. It is such a conglomerate, and it usually has what we call cyclical cycles, which means sometimes, yes, products can be selling better than other times, and this is one of the first quarters where things just aren't doing that well, which has set the stock into a free fall. But if we keep scrolling through here, if there's anything interesting I can show you guys, I like the fact that they show organic local currency growth by area. So here they kind of show what you're getting in growth over these companies. And I imagine when they're talking about currency growth, they are literally talking about how much of these countries are paying them with the conversion after the fact, which we can see foreign currency translation has actually been down. But overall, guys, 7.9 billion in net sales, actually minus 5% year on year, which is not a good thing. And we got 1.7 billion, 11.6% minus year on year, and 1.3 billion minus 14 year on year. And this is just as of this first quarter, by the way. This isn't something that has been going on until recently, which is why the company is tanking, which is, again, why we're talking about if you believe this company is just going through a cyclical cycle. So if we look at their books, really easy to understand here, guys. So right now, guys, we're sitting on a total assets of about 39 billion with a total current liability of about 29.3 billion. Not terrible, not great. But the reason, like I was saying about the dividends, guys, is they're only doing about a 60% dividend payout ratio, which essentially just means, so for their cash net profit, they're paying about 60% of it, which means they actually have room still to grow their dividend. They actually left lots of room, and they left some cash on the table to make things a little bit more understandable. So if we go in here, guys, we can actually divide all that out by just looking at their cash flows and their cash from total operations, and we can even get into their net income on the balance sheet, and we can see just by their earnings per share, they're not actually paying out a huge amount of their profits, which is smart because it leaves them room to adjust to things like this. And I think they're doing exactly what they need to do to keep this company on track. Long term, who knows? Maybe we could get a good year of non-growth or stagnation or whatever. But at this rate, this company hasn't seen, we're talking about a 52-week low here, guys, and a company that hasn't seen a dividend payout this high in a while. And this might be one of those hiccups you might want to pick some shares up on. It bothers me because I analyze it so much. And this kind of reminds me of a time when Starbucks was under fire because Starbucks was closing off some of its major places that weren't making them any money, and people saw this as a bad sign. And we saw Starbucks go from back here, not even a year ago, guys. It went from almost $60 a share. Well, it was it was pretty much around $60 a share when it crashed all the way down to like 50 and was hitting into the 40s. And a lot of people were thinking that was pretty much this dip here that looks really tiny in the overall perspective of it. But that dip there, I was watching it happen. I knew what was going on, and I thought to myself, this would be a great time to pick up Starbucks shares because I really want to get into coffee, and I haven't been able to yet because I've just been watching stocks, and I haven't seen a deal like this again in a while. And I looked at this, and I'm like, they're just closing off the stores that aren't doing that well. Things are kind of leveling up. They still have lots of room to grow and whatever else, and that would have been an incredible time. Bit of a different company, but just like coffee, I just don't think 3M's going anywhere anytime soon. And I think this dip here is starting to get over exaggerated. I figured when on the first tank it wasn't enough because we are talking about quite a big correction, but from its all-time highs, guys, we're seeing this on what a 34.62% correction. So is that worth it to you? I don't think we dropped 30% in sales. So you got to define to yourself, when does this thing become oversold? And I think we're starting to hit that territory now. So I'm going to keep an eye on it. If I get another check in the next little while and I want to just start owning a bit of a different company here, 3M might be a company I might consider adding. I will, of course, let you guys know if I personally buy 3M. I want to know, do you own 3M? If you hold 3M, let me know in the description below. I'd be really interested. Like I said, I'm going to keep my eye on this. If it stays down here, if I get some money in the next little while, there's just so many stocks on sale today, guys. There's a lot of discounts going on. But 3M should be definitely on your radar just because of the size of the company, what they offer, and how long they've been around for. And I think they sit in the Dividend Aristocrat company because they've been around paying dividends for like 30 plus years or something. Beautiful company. If you don't want to own own it, put it on your watch list. It is going to be an interesting one to watch. I'm going to keep my eye on it, but honestly, I think we're hitting a bottom here, guys, and we're going to see. I could be horribly wrong, but I think this next drop that we're having right now is because of the market. The market's just pulling out. So we have the drop from the news, and it kind of got over-exaggerated. Maybe hit a few stop losses, and then from there, recently, I think we're just seeing the market turmoil from the usual you guys bringing the rest of this down. So, like I said, keep an eye on it, guys. I hope you enjoyed this quick video of Dividend stocks. So stay cool, stay awesome. I look forward to chatting to you soon.